Welcome everyone to another group of ExamPrep.ai questions on leases. Let's jump right in and see what they've got for us here. We're talking about recognition of rental expense for new offices that you're leasing. When should that expense begin? When should the recognition of that expense begin? This is a combination of an accrual basis question as well as lease-based question. Now, my thought process here is what makes sense? What makes sense? When is it placed into use? Similarly to when you place equipment into use. Let's see. So on January 1st, a company enters into an operating lease for office space and receives control of the property to make leasehold improvements. Now, first off, right off the bat, that sounds pretty solid. That sounds like a pretty solid date that we would use to begin our lease expenses because we have full control of it at that point. We can do whatever we want, and maybe we don't move into later, which we're going to see, but that's on us. That's not us. You could pay for Netflix for 6 months, and if you don't use it for the whole first month, doesn't matter. That's on you. You're still going to have Netflix expense. All right, so the company begins alterations to the property on March 1st, and the company staff moves into the property on May 1st. Again, it doesn't matter. That's on the company. You're still going to recognize expense because you've been paying for it this whole time and you were able to use it. If you weren't able to use it, then that's a different story. All right, the monthly rental payments begin on July 1st. As we know, this is going to indicate more of a cash basis concept. We don't care. Accrual basis is when it's earned or when it's incurred. All right, that leaves just January 1st here as our final answer. So in January, that's when we're going to begin recognition of our expenses. Awesome there. Let's check out our next question. Gonna get a little more math-based here, which looks good. What is the value of this machine in the company's balance sheet at the lease inception? All right, well, let's see. Company leases a machine from Leasing Inc., wouldn't you know it, on January 1st, year one. The lease terms include a $100,000 annual payment beginning January 1st, year one. The machine's fair value is $500,000, and the residual value, also known as salvage value, is estimated at $20,000. The company guarantees the residual value. Cool. The useful life of the machine is 6 years. The lease term is 5 years. The implicit rate is 6% and is known by the company. Lots to unpack here. Let's begin to unpack it all. And then you've got your present value factors. Now, let's start with our rates, because why not? The implicit rate, you might have remembered, is the rate that we generally want to use. However, you might have another rate given, and that is going to be your incremental borrowing rate. That would be the rate you would use if you don't know the implicit rate. In this case, that's not the case. We know it, but that's just a trick you might incur or encounter in a future question. Just bringing that to light for you. All right, what else do we have? So which amounts are we going to be using? Well, the useful life of the machine is 6 years. The lease term is 5 years. Okay, well, we are leasing the machine, and how long are we leasing it for? Well, we're going to be leasing it for 5 years. We don't really care about that 6th year. That's the problem to record that on term of Leasing Inc. We are the company. We are the unnamed company. So I'm going to initially cross out all of these 6-year amounts. This is talking about the present value of the lease from the perspective of this company leasing the equipment. So we cross all that off. Now let's take a look at our present value factors. And you see, I like to dissect the question before we even think about what the answer is. Let's eliminate the information that's not useful. Okay, so we know that present value of $1 is going to be for lump sum payments. We also know that present value of an annuity due is equal annual payments. Same with ordinary annuity is equal annual payments. However, what's the difference? Equal annual payments for annuity due and an ordinary annuity. Gosh, that's a mouthful, but so what's the difference there? Well, think about it for a second. Annuity due is when you make payments at the beginning of the year. Ordinary annuity is when you make payments at the end of the year. And why is that important? Well, because that's a whole year that's gone by, and that's a whole other year of present value, a whole other year of time value of money taking its toll. So we look through here. Does it say, do we make payments at the beginning of the year or the end of the year? Well, wouldn't you know it? Annual payment beginning January 1st. That is the beginning of the year, so I am inclined to cross out the ordinary annuity. This is not a factor we're going to be using. Remember that these factors are generated by actuaries. You'll never have to worry about determining these, like calculating these. They'll be given. You have to worry about choosing the right one, but these factors are here to show you what your money is worth in the future. All right, so now we need to start factoring. Let's get down to business here. Now that we've kind of eliminated some unnecessary pieces of information, let's begin from the company leasing the equipment. What are we doing? We are paying equal annual payments. Equal annual payments of what? Well, equal annual payments of $100,000 right here, $100,000. How do we factor this? Well, we're going to use the equal annual payments rate at 6%. And that's basically saying, so normally in basic thought process, you'd say we're paying $100,000 for 5 years. So you'd say it's $100,000 times 5. However, because we're factoring this and we're taking into account time value of money, which is not something you always do, but in questions that they mention it, for sure, you're going to take it into account. Instead of 5, our money is only going to be worth 4.4651 for every 5, which leaves us with an answer here of 446, 510. Now, we're not done yet. And why are we not done? Well, we need to take into account the residual value as well. This residual value of $20,000 times what factor? Well, it's a lump sum of 0.7473. That's going to give us our dollar amount of, give me a second to calculate it, 14,946. And then final answer here, we are going to add up both of those for our final answer of $461,456. The company at the lease inception is going to have its value as the residual value as well as the payments that they're making. This is the treatment from the leasing company, the company that's leasing from the other company. And I don't like to use the words lessor and lessee because honestly, in all seriousness, people get confused by that, and I don't blame them. It's tricky. So the company that's leasing from the other company, this is what they're going to record at the lease inception. Final answer here is going to be letter B. Awesome. Thank you all for joining for another wonderful question. Today was on leases. Practice, practice. You will get through this test, and you'll move on to more fun things, more fun than this. But thank you all for joining, and have a great rest of your day.